assessment on the MSc. I didn't do all of them, which I should have done in hindsight. That was your advice to us, was to do all of them. And I definitely should have done that.
Ladies?
I did, not all of it, but just...
Did you do them without looking at the answers? And so what did that tell you when you did them and got them wrong?
Areas that needed further attention.
The rules that were applicable to those areas.
So when you got things wrong, what did you do?
Took a note of the item, the specific item, and the rules, how it was generated.
And then did you go back and have a look
Yes.
at the commentary at the back of the book? Oh.
Yes, and made a tab in the book as well.
In this part of the course, you must do the questions. And I'll tell you why. Because it's actually really mechanical. Once you've worked out what's happening in partnerships, so when you look at partnerships, for example, every time you see partners' salaries, you know that they're not deductible, right? Every time you see interest paid on capital, you know it's not deductible. So if you're doing a reconciliation, you add them back. If you're just doing straight taxable net income, you just don't include it and you put a little thing that says not partnership expense. If you see interest on drawings, you don't include it and you say not income of partnership. When you see partners superannuation, same thing, and so on, right? So the thing is, and then the distribution is always the same. Salaries, interest on capital, less interest on drawings, and then split the difference. Now, you know you're getting a partnership question, right? This section is partnerships, trusts and companies. So you know that's what you're going to get. If you do the questions, right, you only need to do 5, and your brain says, oh, interest on partner salaries, interest on capital, interest on drawings, partner's salary, partner's superannuation, carry forward losses. Ah, yes, I know how to split it, right? If you don't do them, or I had another student who came to see me and said, oh, you know, I think I either got 15 or just failed or something. And I said, and then did you do the exam questions under exam conditions? Did you? Did you?
I did the questions, but they're not
Yes, the exam conditions are very different because you're trying to get it done in 2 hours. Can you find what you want in the book? Okay? And again, did you look at the answers? Yeah.
No, I mean, by doing I did, but then after that,
Yeah. So again, what a lot of students are doing is they're looking at the question and they're looking at the answer. And they're saying, oh, yes. Oh, Colin got that right. Okay? Then the first question you ever do is the one in the exam. So it's got to be under exam conditions, you know, in the library, no music, no phone, no nothing. This is an exam. Now in this exam, you're going to have 4 questions to do. Your time allocation becomes really important. You can't spend too long on one question, use up all your time, and then race through the others. So you need to do it under exam conditions, okay? Because that's going to give you the skills to do it in the exam. Okay? And I'm very conscious of you allocating your time properly. Oh, I forgot to bring markers with me. Say for argument's sake, your exam starts at 9 o'clock. You have 10 minutes reading time, so it's 9:10 that you actually start working. You may decide, I just know the partnership question really well. You've worked out your time allocation. If it's carrying 30 marks out of 110 or whatever, multiplied by 120 minutes, that's how many minutes you need to spend. Okay? Now, say that takes you half an hour. On a sheet of paper, on your writing paper, you write 9:10 to 9:40, and that might be question 2. And then you think, well, I know the trust question better, so that'll be my next one, but that's going to take longer. So then 9:40, say to 10:30. And then partnership question, that's only going to take me 20 minutes. So 10:30 to 10 to 11. And then the fourth question, 10 to 11 till 10 past 10. Oh, 10 past 11. Right? And you actually have them written down rather than 40 minutes, 30 minutes. So you actually know when you look at your, you get that sheet of coloured paper, you write it on there, and then when you get to whatever time, 9:40, stop work. That's it, finished. I move to the next question. Okay? Get to the next, you're supposed to finish at 10:30, it's 10:30, finished, move. What you get sucked into doing, and this is why it's important, especially for this coming exam, to get used to doing it under exam conditions, is that you get sucked in. I just do a little bit more, do a little bit more. I've only got this bit to do, right? The thing is, you can move to the next question, and in that 5 minutes, you can probably pick up a whole heap of marks, whereas you're battling to maybe pick up 1 or 2 marks on the other one. So I offer it to you. It's your choice as to how you want to do this. The other thing is that, what was I going to say with that? Oh yeah, and I've given you 2 papers. I think they're all ready, yeah?
Yeah.
You should do one 3 days before the exam. And then why? Because that gives you 3 days to read up, practice a bit more on the questions, on the things you got wrong, and you should do one 3 days before that. Okay. So this is where your timetabling becomes really important. Okay. So once you know, and the timetable's out, isn't it?
Yep.
The exam timetable.
Yeah, the final one's
So
out.
what you do is you've got your sheet, and you've got your tax exam, your whatever exam, right? So you put those in first, and then work backwards. Okay. Now, to be able to do the exam 3 days before, you've got the exam 3 days before. To be able to do that first one, you must have done all the questions at the end of each topic. So now start filling in your revision time. Okay? From now, because you actually haven't got that long, let's go back and do a trust question. Let's go back and do a partnership question. Just slot it in each day. And then your brain thinks this is important. Mm-hmm. He's still looking at, he's asked me to bring this information back again. She wants me to help solve this problem again. And it's really interesting. I was listening to the radio this morning about the election advertising, and this person who was from some marketing school over east or whatever was saying, just like, what are the ads that you like and what are the things that stick in your mind? And it said repetition. It's the repetition, and it sticks it in your mind. So, It's the only way around it. So understand the concept. And the thing about this part of the course, I've had students get 45 out of 50 in this exam. Because if you haven't noticed, anyone done any trust questions from last week? No?
Other than the ones we've already done.
Yeah. Okay. Do them. Use the flowcharts, right? Don't try and do it without the flowchart. Do it with the flowchart. And what you'll find is it all falls into place. If you follow the flowchart, you look at the beneficiary. Oh, the beneficiary is 19. Therefore, is presently entitled, is not under a legal disability. The beneficiary is assessed under Section 97 at ordinary rates. And it's all there in the flowchart. Okay? So you don't need to even remember it. You just need to follow the flowchart. Oh, the beneficiary is presently entitled under a legal disability. Does Division 6AA apply? Go to your Div 6AA flowchart, which says under 18, yes. Double orphan, fully employed, whatever the other one is, no. Is the income, is it from a deceased estate or something? Yes, no, you know. And then, oh, Division 6AA applies. Trustee is assessed under Section 98 at 47%. If Division 6AA doesn't apply, the trustee is assessed under Section 98 at ordinary rates. Then does the beneficiary have other income? You know, it's step by step. But if you don't do the questions, then when you look at them, it's like, oh my God, what is this? You know, how do I deal with this? But in the end, you'll find, who can I give you? I can give you a beneficiary presently entitled not under a legal disability, a beneficiary presently entitled under a legal disability, Division 6AA applies, Division 6AA doesn't apply. Okay? Then that beneficiary might have other income to which Division 6AA applies or doesn't apply. There are only a few combinations. And once you do the questions, you go, oh yeah, I've done this before. You know, oh yeah, I've done this before. It's really quick, you know.
Can I just confirm, the flowchart is only in the PAP, it's not in the select?
Correct, but it is given to you in the exam.
Oh, the flowchart is in the, oh, wonderful.
Both flowcharts, if you read the unit outline, that document that is the bane of my existence, yeah, you will be given both those flowcharts. And that's why I'm saying you should actually photocopy them on one sheet of paper. And when you sit down to do your questions, you should have it there and you just follow it. And then when you come to the Division 6AA, you flip it over, and that's where your next bit is. So there you go, all my exam hints, up to you to take them. Now, we're going to do companies and dividend imputation. So we'll do the little company bits first, and then we'll get started on dividend imputation. The thing about some of the rules that we're going to look at initially here are because the shareholders are different entities to the company. So what happens when you buy shares in a company, you pay for your shares, and that's the end of it. As far as we're concerned, certainly, in company law world, you can end up with owing money if you're a director, but we're not looking at that. So pretty well, we look at the fact that once you pay for your shares, you have no further liabilities. The company then uses the money to go off and run a business. And it's the company that incurs the losses. Now, this is the mischief as to why we have this rule. Because you've got this separation, here are the shareholders and here's the company, and it's the company making the loss, not the shareholders. Okay? company's got significant losses, what can happen is A and B, who are the two original shareholders, can sell their shares in the company. C and D buy the shares. Okay. Now, C and D are the two shareholders in a company that's got this great big loss. C and D happen to be running a very successful business. So they simply transfer the successful business into the company. Remember, we're talking pre-CGT, and even without it, there are rollovers that you can use to get it into the company without paying capital gains tax. And then what they do, they're the two shareholders, they're the two directors, the loss sits in the company. Oh gosh, the company's now got this lovely business that's making lots of money, and what happens is the loss is offset against the business profits, and the business profits aren't taxed. Now, A and B, they probably were paid a little bit to sell their shares, so they're happy they got some money back. C and D are really happy because they're running this successful business and they're not paying any tax. And so we end up with the special rules which apply to companies. Now, the strictest rules apply to private companies. We will look at private companies. There are more generous rules which apply to widely held companies, but we don't look at that. So we're just looking at private companies. So this is, if you've got your legislation, let's have a look at 165. Um, 165.10, or 5 is your introduction. We're on page 841. No. We're looking at section 165. That's 3 years out of date. So just be careful because things have changed. So you have to use the new law. Okay, if you look at this section, oh God, hang on a second. Oh. Hello? Hello? Yes? Okay. No. Where? Oh, no, she can get in. Yeah, I've left the gate open. Right? And then where there should be the remote to the garage door. What did she do with the remote? Oh, I told her to leave it there. Are any of the Vermeesh's home? Can you see if there's a car at number 5? Oh, geez, she's really stuck. My mum's coming. She needs the remote to get in as well. Yes. Can you see if one of them is home? Okay. Yeah. Okay, thank you. Bye. Oh, clearly made a stop. Okay. If you look at this section, now this is important because in the exam you have to actually quote the particular text. So you need to understand what this is all about. A company cannot deduct a tax loss. So it cannot deduct the carry forward loss unless either it meets the conditions in 165.12, which is about maintaining the same owners, or it meets the conditions in 165.13, which is the same business test. Now, you know the reason for these tests. So then we look at 165.12. In determining whether section 165.10 prevents a company from deducting a tax loss, the ownership period is the period from the start of the loss year to the end of the income year. That's the ownership period. And then it says, this is the important thing, there must be persons who had more than 50% of the voting power in the company at all times during the ownership period. So what that's saying is, from the start of the loss year, 1st of July, to the end of the recoupment year, 30th of June, and all the time in between, the same people had to have had more than 50% of the ownership of the company. The same people. And more than that, the same people had to have more than 50% of the same shares. Because before the same share rule came in, what was happening, actually I'll see if I can do it for you. Is it there? Have you watched the lecture? Yeah. So you know what this... Conchira, did you watch it? You always smile so sweetly when you tell me that you haven't done it. Blank. Okay, so what used to happen was you'd have A, B, C and D holding the shares. You can't see that. And A might have, so A might have had 40%, B had 40, C had 10, D had 10. It makes a lot, and then it decides to sell. Some of them want to sell out. Now, what happens is A says, oh, you know what? I think we can get this going. So I'm going to buy some shares. Okay. B says, no, I don't think so. I've had enough. So B sells out completely. A says, yeah, I think we can make a go of it. No, I haven't done quite the right figures. How do I want to do this? What did I do? I did a better one in class the other day. Oh, I know what I do. I do 30. And then... Oh, I just can't think. My mind has gone blank. Okay, so in the past, this is what would have happened. You would have put, you would have kept B in with 1, and then you'd say, oh, look, and sell to E. So what have we got there? 39. Now, in the past, what used to happen was you'd put A and B together, because it doesn't have to be one shareholder, it can be a number. So A and B together have got more than 50. And then you say here, oh, look, A and B together have got more than 50. Ta-da! Pass the test. The test now is the same shares all the way through. So what are the same shares that A held all the way through? 30, right? Because it had 30. Oh, gosh. Excuse me. Hello? Where you found it, put it back there. Okay, great. Because then Mum will come in the way you did through the garage, and I've left a key for her there. Okay, all right. Lovely. Thanks, Vicky. Bye. That's all right. Okay, bye-bye. I had new keys cut. It's great fun. My electrician was home. He has a key to my house. So he was there, got new keys cut. I drove home from work. He had left me a key in the garage. So I'm jumping the neighbour's fence, and it was a sight to behold, let me tell you. Trying to get through the dog door, that was a bit ambitious. You know. The size of me, the size of the dog door. Anyway, so it's been great fun. So I'm locked out, she's locked out. So if you look at this now, how many were the same shares, Conchira, how many were the same shares that B held all the way through? We had 40, now he's only got 1. Sorry? How many were the same shares? There's only 1, okay? Because he had 40, sold 39, right? Now he's only got 1. So, 1. No, A bought 30 and then A originally had 30, bought another 30. Okay, so now A's got 60. B had 40, has sold 39, has only got 1, and then the other 39. So he's bought off, A's bought shares off these two. Have I got my figures right? That's right, isn't it? Mm-hmm. Is that 100?
Yes.
Yeah. Sorry? 70. Oh, yeah, that should be 20. Mm-hmm. That makes sense. So that's 100, that's 100. Yeah? Okay. So what this says is you can't carry forward the loss because the same people did not have the same shares all the way through. Does that make sense? So it's not just, so under the old law, A and B put together would have been okay. And what you frequently saw was one shareholder or maybe a couple who'd had smaller shareholdings hanging on with one share, right, just to get them over the 50%. Now, what it does is it goes back and says, what's the lowest amount? So even here, if instead of selling all these to E, you know, if these were hanging on with 2 shares or something, it still wouldn't be enough because you go back to the lowest shareholding. And that's the logic of that. So let's quickly look at this question. What do you think? And if you fail that test, only if you fail that test, do you fall back into the same business test. Okay? So let's have a look at this question. Now we look at the loss for year one first. Do we have more than 50% of people who own the same shares from the start of year one to the end of year three? So A and B own 100% of the shares. What percent did they own in year two in the prior year? Well, we've got 500 shares. How many shares have A and B got? Out of 500? What percentage is that? So have they got more than 50%? No. So they failed the test, haven't they? And it tells you about a change in business, but that happens the next year. Okay, so you see how we look at it? Okay, we look at, so A and B have got 100%, but here, what have they got? So they've only got 200 shares out of 500 shares. Yeah? And here they've got 100%, here they've got 40%. So they failed, haven't they? They failed the test.
Yeah.
Yeah.
I think we're following along. Yeah.
Okay, so here we've got A and B together, we've got 100, but here they've only got 40.
Yep.
So they fail. So then we look at the loss in year two. Now, we've got A, B, and C who had 500 shares, had 100%. What percentage do A, B, and C have in the recoupment year? So they've got 500 shares out of how many shares?
100.
So what percentage have they got?
Over 55.
More than 50?
Yes. Yeah. That applies.
More than 50, ladies? Well, you can tell, can't you? What would half of 900 be? 450. Have they got more than 450? No. You can put any number of people together. So there's no point looking at A and B because they haven't got more than 50% here. So you've got to look at C as well. A, B, and C had 100%, right? What's half of 900? 450. Have A, B, and C got more than 450 shares? There you go. Don't even need your calculator.
Yeah.
Does that make sense?
So the first test that we're doing is to see whether the
We've got continuity of ownership.
sorry, the first application of that particular test is to see if we can carry forward year one
To year
P-
three.
to year three.
So we've
okay.
made a loss. Let's look at our question. We've made a loss in year one,
Mhm.
and we've made a loss in year two. So we want to know, can we offset, and then it says in current year, it's made a profit. So current year is the year in which we want to offset the loss. Sorry? Only if you pass the continuity of ownership test. Okay? So, you know our section said there must be persons who had more than 50% of the voting power in the company at all times during the ownership period. The ownership period is from the start of the loss year to the end of the income year. Yeah?
So the first question we ask ourselves is, do the 100% or do the more than 50% that A and B hold in year one, do they still hold more than 50%?
All the way through.
All the way through.
All
so
the way through.
PY and CY.
Yeah.
Right.
And if it took them 4 years to get into profit, you'd have to meet the test year 1, year 2, year 3 and year 4.
Sure.
If it took them 8 years to recoup, it would have to be all the way through.
Yes. Okay.
Okay? So you can see here, and deal with each year on its own. So the first year we dealt with was year 1. So we said, do A and B, who were the only two shareholders, continue to hold more than 50% of the shares all the way through to the end of year 3? And they don't, because they held 100%, they held 40%. 40% is less than 50, they've failed the test. So the loss in year 1 cannot be offset in year 3. We're not going to offset it in year 2 because we've got a loss in year 2. Then we look at year 2, and obviously we have to put all 3 shareholders together, because that's not more than 50. Together that's not more than 50. I mean, we could have looked at these 2, which would work for that year, but it wouldn't work for this year. So we look at those 3, and then when we compare them in this year, they still own more than 50. And as I say, this simple example, you didn't even need your calculators. You could just tell half of 900 was 450, and they own 500. So you've met the test. So this loss can be offset in this year. But this loss can't. Now, the thing is, you have the fallback test, which is the same business test. But it says, so the same business test says, okay, this is the point at which you failed COT, continuity of ownership test. Here, what was the business you were carrying on immediately before that? Right? So in year 1, it was a travel agency. In year 2, what was it doing? A travel agency.
Yeah.
And then on the 1st of July, it changed to being a hotel. Okay? So we failed COT, shall we say, for simplicity's sake, on the 1st of July prior year. What was the business before that? Travel agency. Now, here we are in year 3. Are we carrying on the same business? No, we're carrying on a hotel. So you failed same business test. Now, in reality, deciding on the same business is quite difficult. Obviously, I can't expect you to deal with that in the exam. So it'll be fairly simple. It'll be something like this. It was a travel agency, now it's a hotel. Quite obviously different, okay? So that's one rule. Now we've probably spent too much time on that. The other thing, the next thing that applies to private companies is this whole thing of excessive payments. If you think about it, in private companies, most private companies are like family companies. Mum and dad will be the two shareholders, mum and dad will be the two directors, and mum and dad will organise everything so that as a family, it pays as little tax as possible. So what you often find is excessive payments will be made to family members. And what the section says is that is not a tax deduction to the company. So therefore, if it's not a tax deduction, the company loses it, the company's taxable income goes up, but the person receiving it is deemed to receive that same amount as a deemed dividend. Therefore, it's still assessable to the person receiving it, except instead now of it being a salary of 100,000, it will be a salary of 75,000 and a deemed dividend of 25. But the company only gets to deduct 75,000. Okay. Now, this was all in your I lecture, so we'll get moving with this. The company paid Kevin director's fees of 100, the commissioner considered 75. So what is the deduction to the company? That's your first question.
75.
75. Okay. But Kevin has 100,000, 75,000 plus 25,000 deemed dividend. Now I'm going to move past calculating the tax. All right. What we're now going to do, and we need to do this bit first, and then we'll talk about the entries in our franking account. Now, I think it's section 8, chapter 18 in your book. Now, I really want you to know this in your book. If you go to 18.330 in the book itself. Now, I don't know that yours is 18, you see. It's the topic called Taxation of Corporate Tax Entities and Their Members. What's your topic? Sorry? 18.330. That's 18.010. Look at these books, never been touched by human hands. You could sell them as brand new, never been used. All right. This, now, why am I showing you this? Don't highlight it, you won't be able to sell it. Never been used. Stop that. Now, go ahead. I'm so horrible. As I said to my students in the other class, once you've survived my class, no boss will ever scare you. And say, oh, you're nothing. Not a touch on Colleen Mortimer. Now, please have a look at 18-387. So go ahead a few. $18,387. There you go. Isn't that it? Yeah.
Yep.
18,387. And there is a fully set out franking account. Right? remember how to do it. It's there. Now, you know why I'm pointing this out? I'm pointing out to you all the things that are in this book. We failed a student 1 year for cheating. And do you know what the student did? In the back of that very book, the student wrote out a full dividend franking account. You know why? The student never read the book. And in the book is a full franking account. So, international student, how much are your fees? How much? A semester. Okay. Failed 1 unit, we're just under $4,000. Because the student never read the book. So that's why I'm trying to show you. Everything you need to know is in the book. If you don't read the book, then that's when you resort to doing all these other things. But it's all here for you. Now, shortly, we're going to look at how to maintain a franking account. Now, here's the history. In days gone by, when I was a young tax practitioner, the company made a profit of $100. It paid tax of $46. In those days, the company tax rate was 46%. Therefore, it had after-tax income of $54. Does that make sense to everyone? Yeah? $100 profit, paid tax, had $54 left. Now, what it did, down here was our shareholder. The shareholder received the cash dividend of $54. Now, at this time, shares were mainly owned by wealthy people, and they were people who were paying tax at the top tax rate, which at that time was 62%. Do you like that? 62%. So the tax paid by the shareholder was $32 until finally there was $22 left. So of that $100 profit, Conchira, what's the matter? Does that make sense? Yeah? So of the $100 profit that the company made, $78 went in tax, either at the company level or at the shareholder level. So you can imagine that people said, oh, God, who wants to invest in a company? Right? Now, that was one extreme. The other extreme is somewhere like Singapore, not Singapore, Hong Kong, which doesn't tax dividends. I remember teaching dividend imputation in Hong Kong 1 year, and this guy just sat at the back of the room going, and I said, what's the matter? He said, we don't tax dividends here. So the idea there is that the company's paid the tax and it should not be taxed again. Right? So it's a company tax, it's not an individual tax, and therefore it's not taxable. So that's fine. So we had tax it like crazy, don't tax it at all, or only tax it at the company level. Now, what the government did was it decided that the rules would change and that we would have dividend imputation, and dividend imputation imputes the tax paid by the shareholder, by the company to the shareholder. So it didn't really happen because obviously the company paid the tax to the tax office. It's now sitting with the tax office. But it's imputed to the shareholder. So what we now have is 30% tax, the rate, and I'm just using 30% because it's just a bit easier to work with than 27.5. But if it were 27.5, it would just be, you know, the difference there. What happens now is that $70 is paid as a cash dividend to the shareholder, but the shareholder is imputed with the tax paid by the company. And so that $30 is now income of the shareholder. So what happens is the shareholder's income now is $100. And you might say, hang on, that's not fair. You only got 70 in your hand, but you're being taxed on 100. But, and this is where dividend imputation has its benefit, you pay tax on the $100. If you're on the 19% tax rate, you only pay $19 tax, but you get a credit for the tax paid by the company. And in this case, you would end up with a refund of $11. So this would be a refund here. If, of course, you had other income, it could just offset that other income. Now, have you been following the election? Yeah? That's right. Labor Party. Not quite. What it's saying is we won't give you that refund. We'll bring you back to zero, but we won't give you the refund. Okay, that's, so when you listen, and even if you're from overseas, you should know about these things because it's going to affect. So I've got friends with super funds who've said we're just going to sell out of our Australian shares and we'll put the money into other things. So, you know, it will affect how things happen. Now, what is interesting is that when dividend imputation first came in, that's exactly what happened. You didn't get a refund. And then people who were on the 19% tax rate said, hang on a second, you're effectively taxing us at 30% on these dividends, but we're only paying tax at 19%. So that's not fair. And then that's when it was changed to allow the refund of the credits. And now we'll probably go back to how it was when it first came in. If, of course, you're on the 32.5% tax rate, you still get the credit for 30, but you only have to pay 2.5. 37, 45, still get your 30, and now you only pay 7 and you pay 15. Ladies, you're looking very confused. Is that quite clear? Yeah? Look enlightened. I need enlightenment. Contrarian? Yeah? Okay. So that is what happens, right? We impute the tax paid by the company to the shareholders. Now, that's really nice if every company made a profit of $100 or $1,000 or $10,000 and paid tax of $30 or $300 or whatever. Of course, in reality, that's not the case. The company will decide, what was it on the radio this morning? One of the banks decided to pay, it's either 84 or 94 cents a share. Right, so it'll be 84 cents by however many shares. So it's certainly not going to be, the dividend is not going to be some nice little figure like $70. So the question is, how do we know how many franking credits, which are the tax paid by the company, How do we know how many franking credits the company's got that it can give its shareholders? Now, when dividend imputation first came out, so for example, let me give you a little example here. If this is year one, if this is year one, let's say our company made a loss of $100. In year two, our company, and to keep it very simple, this is cash, right? It makes a profit of $200. Let's look at the cash position separately here. It's got $200 cash in the bank. When we calculate its taxable income, we get to offset that loss. Okay, that's our carry forward loss. We've met our continuity of ownership test, so we can carry forward the loss. And our taxable income is $100. Yeah, yeah. So then it pays tax at 30%. It pays tax at 30%, $30. And it's got $70 of sort of after-tax income. If we look at our cash position, we've got $200 sitting in the bank. Oh, we better pay our tax bill, so that's $30. And cash-wise, what have we got left in the bank? $170. But you can see that we've only paid tax on $100. Our taxable income was $100 because we had the carry forward loss. But our cash position is that we've got $200 and we pay our tax of $30, we've got $170 left. If we want to pay that $170 to our shareholders, we haven't got enough credits, have we? Because you can see from back here that on the $100 we paid 30, we paid out 70. When we get the 70, we add in the 30. But now we've got more than 100. Now we've got 170 in cash that we can pay. We haven't got enough franking credits. We've only got enough franking credits to pay $70, but we've actually got this extra $100 of cash. So what used to happen was that if you had different categories of shares, say your A-class shareholders were your taxable Australian shareholders, you would give all the franking credits, you would give the $30 worth of franking credits to the taxable Australian shareholders because they can use it. Now, you then declare another dividend to your overseas shareholders. As it turns out, overseas shareholders don't like franked dividends because they can't do anything with the franking credits. They prefer an unfranked dividend, pay withholding tax, and then they can use the withholding tax in their country as an offset. So they don't like franked dividends. So they don't care that it's not franked. So you say, okay, I've got this much cash, but I've only got these many franking credits. So what I'll do is I'll use my franking credits for the shareholders who use them the most, and then I won't have any left to give my other shareholders. Now, A-class shareholders were happy, B-class shareholders were happy, Commissioner was unhappy. So the Commissioner brought in this rule. And the rule is that whatever percentage you give your first shareholder, your first dividend, this is in your book at 18,350. Oh, sorry, where should I be? I should be here. 18,350. in your book, the benchmark rule. And if you also look at 203.15, so keep one hand in here and go to 203.15. $203.50, sorry, what did I say? Oh, sorry. 203.50.
Whoops, too far now.
$203.50. And this is the section of the Act that we're looking at. Are we in the 97 Act? 97 Act, I'm asking you to look at the section. 97 Act, 203.50.
Breaching the benchmark rule.
Okay, just back. Back one.
Less
205, so you've come too far. 203.50. Yeah. What it says is, whatever percentage you frank the first dividend to, you must frank all subsequent dividends to that same percentage. So if you make your first dividend 100% franked, so you know the 100 minus 30, 70, if you give the 70 as cash and attach 30, that's 100% franked. You must do that to all subsequent dividends for a private company in the year, for a public company every 6 months. So if an entity makes a frankable distribution, oh, sorry, I'm looking at the, If an entity makes a frankable distribution in breach of the benchmark rule, it's going to pay over-franking tax or a franking debit. And then you can see here how we calculate it. Oh, that's right. 203.15 has actually got how you calculate the benchmark rule, but for some reason that's actually missing from the book. I remember we did that in our Monday class. Anyway, it doesn't matter. If you have a look at the bookets at 18.350, so let's look at the paragraph reference, 18.350. So the first thing you need to do is you need to work out, actually go back to 18.340. First thing you need to do is to work out your maximum franking credit. How many credits can you allocate to this dividend? Now, the logic here is that you can't allocate more credits than the tax you paid. So if your income, now I hope someone's got a calculator out, you can do this for me. If your income, if your profit was say $20,567, what's your tax payable at 30%?
6,170 and 10 cents.
All right, and therefore your after-tax income is?
$14,396 and 90 cents.
Yeah? Does everyone understand what I've done? I've multiplied 20,567 by 30%, company tax rate. Yeah? So this is 30%. Now, if I decide to give that full 14,396.9, or say 14,397, for the moment, I'm actually going to just get rid of, I'm just going to get rid of that, the cents, just for now, okay? Just because we're just learning the concept. If I want to pay this as a dividend, I cannot attach more than 6170 in franking credits. So that's the first step that you take, is you work out your maximum franking credit. So I can attach $5,000, but I can't attach 7,000. The most I can attach is 6170. Yeah, that's the rule. That's the sky is green rule. Okay, you can't give more than you paid. So if we're looking at maximum franking credit, which is also in 20260, which, oh, that's right, we haven't got that one either for some strange reason. I seem to have missed out on a few sections. Anyway, maximum franking credit is the amount of the frankable distribution. So that's our distribution, the 14,367. You looking at the formula? No, it's not in the front. That's what I said, the section's not there. So we're just going to look at the formula here. We've got the formula there. Okay. Got the formula.
18,330.
18. Maximum franking credit.
Distribution.
There.
Okay.
Okay. Now, this is where it gets complicated, and it used to be simple. But for simplicity's sake, so the formula is the amount of the frankable distribution, 14,397 in our example, multiplied by 1 divided by the applicable company, the applicable gross up rate. Then what is the corporate tax gross up rate? 100 minus the company tax rate, so that would give you 70, divided by the corporate tax rate, 30, or 72.5 divided by 27.5. And so that under the 1, okay, so we're just following the formula, but if you did that, now in this book here, now, see in that old book, that's what you haven't got, because it's changed from that old book, okay? If you look at page 318 of this book, if you look, now have you got a new book? Oh, not sorry for me. The thing is, you're now dealing with really out-of-date materials, because these are all the changes that have come in since then, and you don't have access to them. So if you look there, when you do that 100 divided by minus the corporate tax rate divided by the corporate tax rate, and then you do the 1 over that, and all the rest of it, it comes out to 2.33333, and you multiply, so when you put the 1 over that, you multiply the dividend amount by 0.42857. See that? Now, what I did, this isn't my book. Every time as I drive here on these replacement Thursdays, I get about halfway here and think, I left my lecturing bag at home and it's got all my stuff in it, which is why I'm so disorganised when I get here because I haven't got my bag. But what I suggested to my students in class is that, see at the back of this book, on page 378, where we've got the company tax rates. So go to the back of the book. So we've got now, you see that's 27.5, not 28.5. And what I'm suggesting you do, is next to non-BRE, write 0.42857, and next to the other one, 0.37931. And non-BRE is 0.42857. Okay, so this SV has become BRE, base rate entities. B, okay, and that is 0.37931. And this one is 0.42857. So 42857. The 30%. Yeah. So you don't have to go through that complicated formula. You simply multiply. So here you would simply multiply this, because we're looking at the 30% tax rate, by 0.42857. And just to show you what does it all mean, if you do multiply it, you get that times that. That was exciting, wasn't it? Okay, and there's your tax that the company paid. So what it's saying is you cannot attach to the dividend more tax than was paid on that income. Okay, so that's your first thing. So if this were my company and I wanted to pay a dividend, now for one, I don't have to pay the 14,397. I might decide I want to keep money because I need to reinvest in the company. So I might just decide to pay $10,000 as a dividend. I'm just making a decision. I've just chosen 10,000. I could decide 5,000. I could decide 5,600. Okay, this is the dividend I'm now going to pay. Okay, I'm going to obviously gross it up by, multiply it by this amount. And there you go. That's how much tax I can attach to it. So that's your first step. What's the most tax I can attach? But I don't have to attach $4,285. I could decide to attach $4,000. I could decide to attach nothing, or $3,000. But whatever percentage I frank that first dividend to, I have to frank all the subsequent dividends to the same percentage. So how do I know what that is? This is when we now come to the benchmark franking percentage on page 2076. So from where you are, probably just turn one page. So just turn one page. So now we've got, okay, the benchmark franking rule. Benchmark franking rule. So now it says here, for our benchmark franking rule, it says the franking percentage is the franking credit allocated to the franked distribution divided by the maximum franking credit for that distribution. So we now know, let's look at our $10,000 let's look at our $10,000 dividend. All right? The most we can distribute is $4,285. Yeah? Yes? That's the rule. The rule says multiply it by that 4.28457. That's it. And you can see where that figure came from. Okay? Just to go back and show you, if we took our $70, remember our very simple little example, right? And if we see how we get back to the $70, that $30? Yeah? Remember I said $100 profit, $30 cash. What have we got left? 70. If we want to pay $70 as our dividend, Kunchiri, what's the matter? Do you understand? So we want to pay $70 dividend. Yeah? What is the most tax we can attach to the $70 dividend? We can see from here that it was 30, can't we? Right? If we follow that example, right, if we put this in, multiply 70 by 0.42857, and what do you get? 30, right? So this is a mechanism for telling us how much tax, what is the most, well, what is the tax that was paid so that we had $70 left or $10,000 left. It's a formula. Yeah? Okay. So now, if we follow this example, we know that the most tax we can pay is 42857. But let's say, so this is our maximum franking credit, the 4285. The most, that's the most. So if we follow this formula, now let's say we decide we don't want to give $4,000 worth of franking credits. Okay? Or it may be that even though we do this little formula, that we may not actually have enough franking credits, because remember we're talking cash position versus franking credits. So while this is the maximum you can give, you may not have it to give because you've got carry forward losses, you've got income that you've come in from overseas, which is non-assessable, non-exempt in Australia, so you've got the cash but you haven't got the franking credits to go with it because you haven't paid tax in Australia. So while this is the most, you can pay some smaller amount, and in some cases you may have to pay a smaller amount because you haven't got enough franking credits. So if we decided we were only going to pay $3,000, so we're going to say to our shareholders, we will pay you $10,000 cash, but we will only give you $3,000 worth of franking credits. Now, what is that percentage? So if you look at benchmark franking percentage, it's the franking credit allocated to the dividend. How many credits did we allocate? 3,000. Okay. Sorry. Now, what is our maximum franking credit?
4285.
428. Shall we say 4286, just to keep things simple? What is that percentage?
Shrink to that.
You have to do this.
69.99, 70%.
Okay, so let's just, oops, 70%. Oh gosh, sorry, don't know what I'm doing there. 70%, yeah? Okay, now, when we come to pay our next dividend, we must frank it to 70% as well.
Exactly, not more, not less.
Exactly.
Okay.
So if you go back to benchmark, the consequences are, if you underfrank, you've got a franking debit. If you overfrank, you've got franking additional tax. So if I said to you, okay, we're now going to pay a dividend of $15,000. Calculate for me the maximum franking credit, please. Calculate the maximum franking credit.
Yeah, I got that one there. But then that's at 100%. If I only do it to 70. Is that right?
Oh, so you're going down.
So then I've taken that amount and reduced it by 30%. The maximum is 6,000 something after.
Yep.
But that's at 100. So I think we'll find
Yeah,
out in a
that's
second.
Yes, I think everybody's got that figure. Everyone seems to have the same figure. What was it? 6? 6 4?
Just round up to 6429.
6429.
Round it up.
So that's 100% franked. But what can we frank it to? 70. So we can only attach franking credits of 70%. So we can only attach, let's make sure I press the right button here. That may not work. So even though the maximum is 6429, we can only attach 5. Now, if we attached 6429, we would overfrank. So if you go back to 20350, now, if you look at 203-50 sub 2, actually, if you look at 203-50 sub 1, it says if you make a franking distribution in breach of the benchmark rule, you pay over-franking tax, and if you underfrank, a franking debit arises. And then the formula is the amount of the frankable distribution multiplied by the franking percentage differential. So it should have been 70. If we frank it to 80, what's the differential? 10. Yeah? If we franked it to 50, what's the differential? It should have been 70. We're franking it to 50. 20. Okay? So it's the differential by that applicable gross up rate, you know, that 2.33 thing, whatever. Now, have a look over the page at that little pie chart sort of thing. See, it shows you there's your first dividend franked to 40, your second's franked to 30, your third's franked to 50. See your differential? The differential for each one. And then, if we come back to 2076, page 2076, And there is an example of your benchmark rule. So can you see why I want you to look at this book? This is the book you take into the exam. You've got a new one, haven't you? And where is it today? Home. Must love being home. I don't think it's ever made an appearance at university.
Too cold outside.
It's safe. Oh, it's too cold. Okay. All right. And wet. Didn't want to get wet this morning. All right? So there is your rule. Whatever you do to one, you have to do to all subsequent ones. Right. Now, let's have a quick break. And let's join our class. We're such a select little group. Okay, let's have a quick break and we'll come back. Yeah, and what we'll do is we'll do a couple of those examples in our thing, and then we'll start to look at franking accounts. Okay.
Just me. I'm returning your call. Sorry, I was in a tax lecture. We're having a break. Yeah. Oh, did you? Please share. Yeah. Yeah. Right. So you think you think it all makes sense? Mm-hmm. All right. Fair enough. Not even an nephew. Not even a nephew will do the job. That's funny. Hey, are we still on for tonight? Mm-hmm. Yeah, I'm still keen. Martha can't make it, unfortunately, but I'd be keen to still do it, unless you want to. She has prior engagements with another friend. I did tell her that, actually. Yeah, she said I can cancel if you want, and I was like, no, it's okay. So I'm looking like I'm going to finish here at 4 o'clock, somewhere between 4 and 5. I was going to ask whether that would be suitable. Yeah. Okay. Okay. Yeah, it'll be at least. Sorry, I'll be at the earliest. I'll be leaving here at 4. Probably the latest, I'd say 5ish. Yep. No worries. Will do. Bye. I get that. When you walked in, I sort of. Oh, okay.
So like at least I sit here.
Yeah.
When she don't, I fix it.
Yeah, that's good. When you walked in, I nearly burst out laughing because I saw your face. And you went, and then you ran back out. It was classic.
Then I have done my this thing, my finance.
Finished?
I have done the Excel for you.
Hmm?
Can you just check if you get that?
Let's have a look. You got it?
Yeah. I have done what? Look here.
Sorry?
Look here.
Yeah.
And I was finishing it off somehow because
Nathan has finished his, yeah.
it's not that hard. It's just
Have you done the report? The write-up?
doing it. Which one? Not the company one. Company. I haven't trusted because I was doing this.
No, finance.
Yeah, I'm doing now.
Yeah.
This is done. That other thing will be easy, right? Only thing, the depreciation I have to find that pens from add back and all. I have to find one.
Oh yeah, because it's a non-cash charge, so it affects the tax that you pay. That's right. So you add it in, then you take it back out.
I don't know how to use this one.
No, I've never used those before.
Here.
There you go. Oh my god.
But actually, she's good when compared to other teachers because we literally out of fear we learn. Like when she comes near to me, I'm like, oh shit.
No, it's good.
Yeah.
Oh, you're all set with your lunch. I should have done that.
Yeah.
Yeah.
Guys, what is this? It's cold.
Well, that must hook it to another table, I think. Oh man, Nathan, I'm feeling it. Check. Fresh.
I have enough time to study. Next time I should have this.
That one? Strong.
Thank you.
Yeah. And there's no sugar as well, which is good. Not too sweet.
Is it IRR? IRR, you should find out the discounted rate or on the original cash flow.
Oh, I don't remember. I didn't do an equation for IRR. I just put it through Excel. We found that. You know where we found that? In the computer labs. This morning we found it.
I thought of keeping the same one because I searched for it, but I couldn't find it. For my this one.
I don't think we're going to have time for sugar.
I'm really. This one is like, it took some time for like, I have to learn the Excel, I have to do this.
You're not feeling so great about that right now.
Yeah. It's going to be a late one tonight now.
Yeah, it will be. Yeah, for you, I think it will. It's okay. It's once you're confident in the numbers, you'll be able to do it.
At least it's started the report. Fairly.
Why is it taking time?
When is it due?
We don't have time for sugar, it's okay.
Do you know when it was due? What time?
What was that?
See, 12 o'clock we have to submit the online report, and in the class, during the class, you can submit the original report.
So you
When's the class? Morning or
Friday.
Afternoon? So you can do the physical later than that. Okay.
So probably we'll happen the second part.
How you going?
So this is
Do you
going to
have,
be anyway. So.
Intermediate corporate accounting? Oh, okay.
Lucky you are
Yes,
serious.
very lucky. You've got an assignment due tomorrow afternoon. It's been extended, but it's lots of assignments this week. It's been
How are
very
you
full.
going with it?
Yeah, not too bad. Can't wait for it to be done.
You have law same like me.
Law?
Tax,
Yeah,
finance.
yeah.
Instead of this accounting, what you've taken?
Applied international tax.
semester for me?
Yeah, I've noticed it's been a significant jump in terms of the difficulty of the content as well as the assignments being clumped together. I've noticed compared with last semester, it's been a big jump in difficulty, I guess.
It hasn't been like that in the past.
No, well, last semester it just seemed to flow really nicely. The assignments weren't too close to each other. So it just felt, there were still moments where it was quite stressful. Well, not stressful, but, a bit intense.
At least you had one day to work on something and then another day to...
Yeah.
Whereas this semester, this week, there's like 3 things due, and then the next 2 weeks there's another big thing due, and then exams are around the corner.
Oh, the assistants were out like at the beginning of the...
No, not
Yeah.
with us.
Oh, did they come out during the...
But finance was out for long.
I'm not
Yeah,
sure.
finance.
Sorry, I need to make this call.
Yeah, no, corporate accounting got released virtually after MST, same data.
How are you guys going with that
Also
school on
from beginning
Friday?
Sorry?
How are you guys going with that school on Friday?
Yeah,
Finance?
Yeah.
I finished the
It's due on Monday now. She said that in the
No, this one.
This one is...
Finance.
finance.
corporate's due on Monday
Monday,
now. Finance due Friday still. I noticed this morning, actually, I buggered up some of the numbers, so I've had to go back and do it all again.
which one?
Finance.
If you make a mistake like 0.2 instead of 0.02, that's
Oh no, it's put depreciation in the wrong spot, which screwed up my cash flows.
fixed cost. It's a fixed cost.
Yes, it's straight line is depreciated. The depreciation schedule is a straight line, but I added it and then deducted it past my EBIT, not before my EBIT, which that's the city's to do that. Thankfully, all the
Have the PowerPoint open on the side and then hand it over.
oh no, I know how to do it. I didn't add it to the right line correctly, so thankfully I had formulas for my things, so I just moved it and it sort of fixed it.
So what's
To
your
find the
RPD?
RI, do you use the
Um,
discounted one or the
For
do you use the discounted cash flow
For?
or the
for me,
40 million?
IR in terms of like the NPV comes
Right.
to
Ask here, I didn't get past that yet. So that's the one.
but as I said, I've made an error, so I'm trying to fix it and make sure I've done all the other silly errors. So.
I think finance was comparatively easy compared to law. Tax?
No, like we're interpreting it something else.
Yeah.
She's interpreting it something else.
Luckily I passed this class.
It'll be an interesting discussion on Monday.
On law?
Yeah. Tutorial?
Law is fun.
Is the other day from guys who are not doubts.
Sorry?
That too was Monday is kind of yes, lots of doubts.
Oh, that guy. Him and his friend, they never came.
Did they give us one for
Is
these?
he like, is he like in straight law?
Yeah, that one.
Tabra?
Yeah.
He's in Tats is back.
Sorry?
Tats. The guy with all the tats.
Oh, he's
He's
back.
doing law now.
Oh, cool.
But he stopped.
They stopped coming again. He did that last semester in financial accounting, wasn't it?
Yeah, I think he's juggling.
Yeah,
Full-time
working
work.
that. Yeah.
That's his name, is it?
I forgot his name. It's just iconic. You see him, he looks like a bikie, basically.
He looks like?
a bikie.
Oh,
He's a sweet guy though, it's very nice.
Yeah, yeah.
right.
It's not the you got to look at the contents, not the front page.
Yes, but you see, my feeling about tats is, would you put a bumper sticker on a Ferrari? No. Or a Bentley? No.
I would. I'd put a toe ball on it.
No, you wouldn't. Okay.
I'd like to tell it with a Lamborghini or something.
Now, we need to do all that so that we can actually do our franking accounts. Now, the thing about a franking account is, I'll go back in here because this is just the document I'm using. Now, if you remember this, franking accounts are really easy, and people people, make sure you do at least 3 franking accounts between now and Sunday. And do you know what? You'll get them. And when you see a franking account in the exam, you will send me waves of love saying, thank you, Colleen, because a franking account, every time you see an instalment of tax, it's a credit, 1 mark. Every time you see tax payable, it's a credit, 1 mark. So a franking account can be 12 marks, like that. There's no thinking about it. Instalment, credit. Dividend paid, work out the amount of the debit. Under franking, work out the amount of the debit. And it's the same, every single franking account. So it should be this fabulous, fabulous thing when you see it in the exam. It's not to say there will be one, but... Now, remember this. A franking account records the tax paid by the company. No, it didn't like that, did it? That is what a franking account does. I want you to write that in your notes. I want you to highlight it in your notes. Write it by hand in your notes. There are now more and more studies proving that when you write it as opposed to typing it, it sticks in your head better. Now, every time the company pays tax, it is a franking credit and the account goes up. Every time it gives that credit, it gives that tax away, the account goes down. That's a debit. So let us look now. Now again, just leave something in your, at page 2076, because we'll go forward. Oops, no, that's not going to work very well. Let us look at 205.15 in the Act. (205.15) in your Act. And there are your franking credits. 205.15. Yeah. And there are your franking credits. And you can see that your franking credits, so these are the ones we're going to do. The entity pays a pay-as-you-go instalment. It's the amount of the instalment on the date the payment is made. So it's paying tax, it's paying an instalment of tax. You know companies pay tax in quarterly instalments. So it pays its tax, the account goes up. The second one, the entity pays income tax. It's the amount of the payment on the date the payment was made. Second credit entry. Now, maybe it's the first year the company's paying tax, so it has no instalments, so it'll pay its income tax. Or after paying its instalments, it needs to pay some more tax. That's a credit. Look at 3. A frank distribution is made to the entity. Now, this is the one, be careful, because it's not the dividend, it's the franking credit on the dividend. So now we're looking at item 3. Okay, so this one here. So, but be careful because notice that the credit is the franking credit on the distribution, not the dividend. So if you're getting the $70 dividend, well, yes, okay, so it's the $30, it's not the $70. Yeah, and you'd use the 0.3 if it was at 27. Very good. Okay. Oh no, you can't write that on there. But it tells you that. Take that out, or your book will get confiscated in the exam. Did I just hear rude words? Do I need to wash mouths out with soap? Now, the next one, this is a really tricky little one, okay? A frank distribution flows indirectly through to the entity through a partnership or the trustee of a trust. It's the share of the franking credit. The time is specified in subsection 2, and if you go to subsection 2, just over the page, it says franking credit covered by item 4 arises at the end of the income year. So it doesn't matter when it's paid, the credit in the franking account comes in at the 30th of June. So this is when your company is getting a dividend that's passed through a trust. So the trust was a shareholder, the company is a beneficiary, and it gets the dividend passing through it, through the trust to it. Those are the only ones we need to look at. Oh, sorry, if you go down, no, look at 5, franking deficit tax, which we'll look at shortly. And then if you go to 205.30, you've got your franking debits. The entity franks a distribution. The amount of the franking credit on the distribution. So this could be, you multiply it by your maximum franking, you multiply it by your 0.42857, get a figure, but you might decide that it's, that figure, some lower figure, and it's that, whatever that figure is, that is the amount on the day the distribution is made. The entity receives a refund of income tax. It's the amount of the refund on the date it's received. And that makes sense because, say for example, you've paid your 1 quarter, right? So your franking account went up. You paid your next quarter, your franking account went up, 3rd quarter, 4th quarter. Then you lodge your tax return and the Commissioner gives you a refund. So it was credit, 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 debit. Because you've obviously paid too much. So all the credits took you up, all the payments took you up, the refund brings you down. And a franking debit, come down then to 3. A franking debit arises under that paragraph if the entity franks a distribution in contravention of the benchmark rule. So that's when you've under-franked a dividend. So remember our original one, we franked 70%. If we franked the next one to 60, that 10% differential will be, do the calculation, that'll be our debit. Okay, and that's it, right? Franking credits, franking debits. So what we're going to do now, we're going to go back to our notes and we're going to start work on our franking account. Now, a franking account must be done like this. It is in chronological order. So you must get the dates right over here. So you have to look back here because the dates are all over the place. July, October, that very important date in November. Okay? Debit, credit. So let's get started and put in our first date. which now here, our opening balance is 0. We're not told otherwise, so we'll start with an opening balance on the 1st of July of 0. So we're going to have date, item, and then debit. Oops, I can't type. Ah, go away thing. So what was our first thing that we had? So 1st of July, we had our opening balance is 0. So your balance will either be 0 or the surplus. And then I think on the 28th of July, we paid an instalment. Now, is your instalment a debit or a credit? Remember, franking accounts recording the tax you pay. So you're paying an instalment, the account goes up. It's a credit. Now, if you're not sure, go to that unit back. I showed you that franking account. What was it? 18387? Okay. There. Okay. If you're not sure, can't remember, you've got a full franking account in your book. Okay. Okay. There you go. Full franking account. In the book that you can take into the exam. So your first entry, your tax paid, your instalment, is that a debit or a credit? And how much did we pay?
30,000.
And our balance is 30. Now what's the next date? First of October. Now have a look to see how much is the debit, or the credit, I mean. Sorry. It's leading you astray.
So I could be wrong here, but that's what I'm. No, that's not. Yeah. No.
I don't want you to show everything.
Yeah, I think that's it.
Okay, so have we done the one on the 1st of October?
I think so.
So it tells you that the cash dividend was 21,000. It had been franked at the 30% rate, but only 20%. It was only franked 20%. So how do we get, so here's our $70, right? 130.70. Our $70, the equivalent is the 21,000. How would we find out the tax payable on it? Multiply by 4.2857, but only 20% is franked, so multiply by 0.2, which gives us
About 1,800.
1,800. Yeah. Okay. And what's our balance?
31,800.
800. That was a massive arithmetic calculation there to be done in one's head. Then your next item is on the 28th of October. And then the 10th of November. There's no use. That's all you do is look at them instead of working the question. what would be the maximum franking credit? Multiplied by. Yeah. Yeah. So it's only franked 20%. But that's 50%. Multiplied by 1.2. 20%. All right. Always, if you're confused when you first start, always come back. Now let's make sure, yes, we've got a duster. Always come back to this. All right? So we know that to get from here to here, if we multiplied 70 by 0.42857, we know we get 30, don't we? And that's our maximum franking credit. Yeah? Yeah? That's really simple. Okay? If this is your dividend, right, how do we know? Because a lot of the time, the dividend is simply cash that the company has. It's not necessarily this, but it equates back into this. Now, in our question, the equivalent of the 70 is the 21,000, isn't it? So if we know this figure, what is this figure? Centurion, right? 130.70 in our example. The 21 is the same as that. So we want to know, how do we get that figure? So 21,000 multiplied by 8,000, 9,000. But it's only 20%. They didn't frank it to 100, they only franked it to 20. So what's 20%? What is it? Yeah? So you have to do the maximum. That's your first step. And then, in this case, it was only 20%. If it was 80%, you'd multiply it by 80%, by 0.8. Or if it was 60% or 65%, okay? So this is your first step. And see how it equates here? Okay? So our next one was the 28th of October. Have you got that one? Then our next one was the 10th of November. First of December.
Should we do according to the points?
Yes, yes, yes. Now, why is that important? Because you're looking after the tax side of things. The directors come to you and say, look, we've got X thousand dollars in cash that we want to pay as a dividend. I'm explaining the question. We want to pay a dividend of X thousand dollars, or tens of thousands, or millions of dollars. How many franking credits can we attach? So you need to be able to look at your account. Now, you can go into debit during the year. That's not a problem. You can go into debit during the year because you might want to pay a dividend in December, and you know that in February you're paying an instalment, in April you'll pay an instalment, you may be paying income tax, and maybe you know that you always get franked dividends from another company. So you know you're going to get more credits during the year. So you might say, okay, let's pay the dividend in December, let's go into deficit, because then when we pay our instalment in February, the account will go up. When we pay our instalment in April, our account will go up, and we'll pay tax in May when we lodge our tax return and balance up, and so we'll have more credits. So, yep, let's go into debit. The only problem is finishing the year in deficit. finish the year in deficit, you have to pay franking deficit tax. And that's simply saying, well, you've given away this many credits, you better pay the tax. Okay, so that's franking deficit tax. Okay, let me give you the date, so at least we're just working through on the same dates. 1st of December, 15th of February, write the dates down. So we've got 1st of July, 28th July, 1st of October, 28th of October, 10th of November, 1st of December, 15th of Feb, 28th of Feb, 1st of March, 28th April, 1st of June, 1st of June, 30th of June, 30th of June. Have you got all those dates in? I'll go back from November, 10th of November, 1st of December, 15th of February, 28th of February, 1st of March, 28th of April, 1st of June, 1/6, 1st of June, 1 June again. There are 2 entries on that day. 30th of June, there's an entry on that day. And 30th of June is your closing balance.
Yeah, there's a 1st of February. Is that current year? Yeah. Oh no, but that's the 30th of June because it's the trust.
It's the trust,
Yep.
That's right. That comes through on the 30th of June.
Yeah.
So if you do that actually, they're going to put out. Okay, so we're doing dollars and cents for this, or should we?
Dollars.
Oh, I forgot what it was. 75%. That we're receiving. Sorry. Yeah.
And then we do that as the maximum times 5 100, is it?
It's just
Franking percentage.
Yeah, that's our first dividend paid. I think. So it needs to be a little further, it's meant to be 100%.
Sorry, I'll put the question. Just hang on. Let me get rid of that. Yeah, even if it doesn't make sense to you, look it up in the book. What does the book say? Eventually, you'll get the hang of it. So what happened? What's the next date? So what happened on the 28th of October? And what is that? Is it debit or a credit? Now, why have you got that as a debit?
That's fine.
Received, not paid. It's when you pay a dividend that you're giving away your credits. When you receive a dividend, you're receiving franking credits. Okay? Doesn't matter. Look at your credits. Think about this. What did I say to you? The franking account records. No. At the very beginning, I said a franking account records. I said write it down in your book and highlight it. No. Right. Tax paid by the company. So every time the company pays tax, the account goes up. Another company has paid tax. Another company, and it attached some of the tax it paid to the dividend, and it gave that dividend to your company. It's tax paid, isn't it? It's a credit. It's not a debit. But if you don't know, see, the reason I pointed this out to you was receipt of distribution. Have a look at it. You see, it's credit.
Properly. It's getting there.
No. We're getting it from another company. This is received, not paid. It's coming to us from another company. It can do whatever it likes. Right? So what do we receive the franks dividend? Is that a debit or a credit?
This one on the 1st of February, which is a trust.
Yeah, but that's the 30th.
I've got two first of June.
And it's carrying credits, isn't it?
Well, if that's been a trust,
So
then it is.
credits, so look at it.
It's only supposed to be one first of June.
That's
Well, I think it's number 3.
It's got to be just
What does
one.
it say? Don't worry about all the rest. It's first bit. Frank dividend is received. How much is the credit?
Paid a distribution. Oh, hang on. There's two because the benchmark law. That's why. So the first thing we do is we count for the
credits attached are the credits in your account.
3, 4.
Think about it. This other company gave its franking credits with a dividend to your company. That's company tax paid, isn't it?
So you did the
What's the franking account report?
42%.
Tax paid by the company. Remember at the beginning I said, what does the franking account record? It records the tax paid by the company. Right? So this is just another company that paid it and it's passing it through to your company.
Now, this is what we need to do, the benchmark, what do we call it?
Well, whatever, and then multiply in this case by 75%.
Just because we're receiving.
We're receiving it, we're not paying it. when we pay, then we must meet the benchmark rule. Okay? This one, we're receiving it. And it's a credit. Yeah.
The core gross upright wasn't the 4,223, wasn't it? Is that right? Amount of frankable distribution was. What was I? 12,000, is that correct? Yeah. Times the differential was 65? No, about 55. I suppose the easiest way to know is to just go 12,000. Cool. Is that right? Cool. Just read it just now. Over franking tax or under franking? Or not even?
Now, on the 15th of February, have you got down that far?
Yes.
Yeah? Now, our company is paying a dividend. So now we're caught by the benchmark rule. So how much did we frank that first dividend to?
100%.
100%. So how much was the franking debit? This is a franking debit. We're giving away our tax paid. We've been paying tax, and now we're giving some of that tax to our shareholders. How do we calculate the franking credit?
Times the percentage and then the difference.
No. What difference? This is the first dividend.
You're supposed to pay only like 42% or something, but they pay 100.
Sorry?
They pay 100 instead of.
It's 100%. So that's your maximum franking credit.
They're supposed to pay less than 42%.
We use the franking percentage, the formula, to find out how much.
Well, what's your maximum franking credit? First step.
9,000
How did you get that?
times 0.42.
21,000 multiplied by 0.42857. And what did that give us?
9,000.
9,000. And is that a debit or a credit? Sorry? Debit or credit? I can't hear what you're saying. Debit. Now, on the 1st of March, we've got a refund. Is that a debit or a credit? Debit?
So we don't have to worry about the 100% that you're franking.
Well, that is 100%.
Oh, okay.
That's your maximum.
Yes.
Okay?
So, not the-
Okay, 1st of March, what is that? A refund? Is a refund a debit or a credit? A debit of how much? 10,000. 28th of October? Oh, we've done that, haven't we? 28th of Feb? Sorry, we should have done 28th of Feb before 1st of March. 28th of Feb, what have we got? Pay as you go, credit for 12,000. Then we should have done 1st of March, which was our refund. Then we've got 28th of April.
Did we go through the 1st of December together?
Worked that one out pretty quickly, haven't we? Yeah, but that's what I'm saying about a franking account. If you get a franking account in the exam, what can go into it? Tax paid, instalments paid, dividends received. Okay, now surely now, the minute you saw instalment, you knew what to do. Yeah, credit for the amount of the instalment. Easy. What? Okay, come back. Come back. What is the franking account recording? Go back to your notes. I asked you to highlight it.
The maximum amount.
So every time you pay tax, the account goes up. So what is it?
30th of June.
If you understand the logic of it, do you get that? That's why I said to you, write it, highlight it, because then the franking account makes sense. Any tax you pay, obviously not FBT and stuff, because it's not income tax, only income tax. Every time the company pays income tax, the account goes up. Every time it gives that tax away, the account goes down. Right? So that's the debit. Now, even if you don't know, look at this. You know, this is why I'm pointing this out to you. Payment of instalment.
Good one.
Tax payable, but if you go back to credits, pays the tax instalment, pays income tax. here are your credits. But what I want you to do is understand what it's doing. It's recording the tax paid by the company. Every time the company pays tax, the account goes up. Right? When it gets a refund, that's a debit. So every time you pay an instalment, that's a credit. You get some tax back, that's a debit. You give those credits attached to a dividend, that's a debit. You underfrank, that's a debit. And they're all just listed for you. But if you think about it, what is it doing? It's recording the tax paid. You pay tax, the account goes up. Give it away, the account goes down. But can you see now why I want you to do 3 of these in the next couple of days? Okay? And honestly, you'll have it. The franking account will be nothing. In the exam, you look at it and you say, okay, and this one's overfranked, this is what happens, this is what underfranked, right? And if you think about it, what can I examine in a franking account? Debits, credits, underfranking, overfranking. Now, one of the fellows at BDO who does some marking for me, he says, but Colin, no one would do that. I said, that's right. Because you've got the underfranking, overfranking section, you wouldn't do it in practice. I give you questions with them just for you to understand the implications. If you underfrank, you're going to lose franking credits. If you overfrank, you've got a penalty tax to pay. So have we finished? Come on. Hurry up.
Sorry,
Getting
can you just
bored.
clarify,
I'm
an
bored.
underfranking tax would be...
It's not underfranking tax, it's an underfranking, and it's just a debit entry in the franking account.
Okay.
Look at your debits. Look at your list of debits.
Yeah. Okay.
So what I want you to do is to look at your debits in the book.
Oh, in here. Yeah.
Yeah.
In the example.
Well, you can look at it. I can't remember if it's in the example.
I think it is. Yeah. So it would be back here.
Where is it? 18387.
Debit entry.
Okay, they haven't got one there. So what you want to do is go to the section on the benchmark franking percentage on page 2076.
Yep.
Now see at the bottom,
Is that
Corporate tax. The example, is that what you're referring to?
Yeah.
Yeah. Corporate tax. 30% first.
okay, and then if you go over the page to 2077, for example, if it makes a subsequent distribution in the same period, in order not to breach it, it must have 300 credits allocated to it. And then if you go back to 203.50 sub 1, it says, if an entity, everybody should probably all look at this, 203-50, now that we're actually doing the franking account, this will make a little bit more sense.
Yeah.
If an entity makes a frankable distribution in breach of the benchmark rule, A, an entity is liable to pay over-franking tax if the franking percentage exceeds the benchmark franking percentage, and a franking debit, just tells you it's a franking debit, arises in the entity's franking account if the percentage is less than the benchmark franking percentage.
So under item, I would refer to it as a franking debit.
No,
In this instance,
under franking.
okay,
Under franking.
sure.
And then if you have a look at that little chart on page 852,
Yeah.
okay, and then you see note distribution 2 is underfranked,
Yeah.
distribution 3 is overfranked.
This is used to work out the amount of the under franking debit. Okay. This is used to work out the amount of the over franking
Now,
tax.
underfranking is what that debit does is it removes all those franking credits out of your franking account. It's saying you should have given these to your shareholders. You haven't, so we're just taking them. And what they do is they've just disappeared out of your franking account. Now, your shareholders would be really unhappy with that because your shareholders would say, we could have used those franking credits, but you've just lost them. So if you were the tax person in the organisation, you would not be well regarded.
No.
So what would be the point of giving franking credits less than the maximum?
You wouldn't.
So
That's what I'm saying.
Okay,
Because of that section, you wouldn't do it.
right. So that's all it's saying.
It's one of those. Here's the penalty if you do it, right? So we don't want you to give all your franking credits in the first dividend to your taxable Australian shareholders, right? And then pay another dividend to your overseas shareholders, right? And attach no franking credits, because if you do, we're going to take your franking credits off you anyway. So it's an integrity provision. It's there to protect the revenue.
Yeah.
So it says if you do it, and that's what I'm saying. The guy who does some of my marking says, Colleen, no one would do this in practice because the penalty would arise. But we need to teach you what are the implications so that when you do go to work, if you are faced with that, you would say, sorry, we have to give, if we've given 100% to the A class, we have to give 100% to the B class. If we give 80%, we're going to lose that 20% of credits anyway. So we may as well give it to you. Or do you decide, because they're Class B shareholders, that you're going to lose them out of the franking account? But it's not highly regarded. But, you know,
So in this
it may
example,
happen.
it's an example of bad practice, essentially, when we're doing it here.
If you did it,
Yeah.
yeah. And it's also like when we do trusts, and we distribute to minor beneficiaries, and he says, Colleen, no one does that.
Yeah.
Yes, I know. In practice, you wouldn't do it. I need to show the students these are the implications of doing it. So remember, a lot of rules are what we call integrity provisions to preserve the integrity of the tax. So it's saying, you know, I'm sure your parents had certain rules. If you do this, this will happen, right? Same thing. If you underfrank, we're going to take your credits away. If you overfrank, we're going to make you pay a penalty. So then the choice is yours. Yes, I will do this thing I'm not supposed to do, and then you bear the penalty, right? So if you do this, if you don't come home by 10 o'clock at night, you will be grounded for 2 weeks. You come home, you know, after 10 o'clock at night, and you're grounded for 2 weeks. So you know the rule, and then you make the choice as to whether that rule will apply to you or not. So this is the rule, right? Under frank, you're going to lose your franking credits. Okay?
Yep.
So they are, as I say, what we call penalty integrity provisions. So let's look at our answer now. So we got that one. Can everyone see? Or is it just me being old? No?
No, that one's a bit dull compared to that one.
Okay. Is that better?
Yes.
Okay, so we've got that instalment. Then there's our dividend that we received. See, this is received. Then we paid an instalment. There's our credit, balance. We paid income tax, it's a credit and it's a balance. Now, let me ask you, so far, who's completely correct? Ladies? Are you right? Yeah? So you know what? 1, 2, 3, 4 marks. Can you see why I'm saying that if you do 3 of them,
Yep.
you'll be home and hosed? Then another dividend received, 3214. Now we pay our first dividend and we franked it to 100%. So we simply did the 21 by the 042857 to get us 9. And now it's a debit. So you see our accounts dropped. Then we've got another instalment, which is a credit. Everyone get that right? You should by now. Another one, Mark. Refund of tax, debit. Another instalment. Yep. And now we're paying our dividend, but we've only franked it to 45%. So that's our debit, and then on the same day we have an underfranking. And that's simply the difference between the 100% up here, we franked to 45, so we've underfranked to 55. Which, remember, we wouldn't do in practice, but we will do in a question. Who got that right? Who got 2314 and then 2829? Great, great. You didn't?
Not the underfranking part. I wasn't too sure what I had to do with it.
We just had to look at your account, your debits and credits. And then our trust distribution comes through on the 30th of June to give us a closing balance. It is mechanical because there's no room for doubt. If it's an instalment, it's a credit. If it's tax paid, it's a credit. If it's a dividend received, whatever the credits are attached, credit. Pay a dividend, the franking credits are a debit, get a refund, it's a debit, underfrank, it's a debit. So the only room that you have for going wrong, but if you do a few questions you won't, is that the first, usually what I do, the first dividend will be franked something like, say, 60%, then one is over-franked, one is under-franked. So there's over-franking, under-franking. But mechanical. Kunchira, what's wrong? All good? Easy? Easy. Mechanical.
The part where it says how would the question change if it was an SBE taxpayer?
Then your tax rate drops to 27.5.
Right, okay.
So
it's a
now-
base rate entity.
So here, this changes
Right.
to the 3 whatever.
Yeah.
These don't change because they're coming from other companies, right? So you can be a 27.5% taxpayer. Boys at the back of the room, have a listen. In the next one, it says, what if the taxpayer were, well, actually it should say BRE, not SBE.
Yeah.
then it only affects the dividends we pay. It doesn't affect the dividends we're getting. Because if they've been taxed at 30%, then they're carrying 30% credits.
So in the absence of information, we assume that it's 30. For,
Yeah.
say, like we own shares in a non-base rate entity.
Yeah. What is going to happen, because it's moving up to 50 million,
Oh, okay.
the threshold,
Yeah.
what you're going to find is more and more will be BREs
Right.
rather than non-BREs. And you're only going to end up with your really big companies.
To pay the 30.
Yeah.
Okay.
So you can see all these here in this answer. Oh. No, this is another one, isn't it?
That's question 10. We were just doing 8. I
Yeah.
think.
Is this the one that says recalculate or?
No, I think it was part of 8. at the
Oh,
bottom.
okay.
Yeah.
Yeah. So that's just the difference. Okay. And then the only thing would be if you finished the year and this was in deficit, in deficit, then at the 30th of June, you'd have, before the closing balance, you'd have franking deficit tax, which is whatever is that amount, and then your closing balance will be nil. And that, my cherubs, is that.
Thank you.
Now, please do some questions between now. You know, if you do even one question within the next 24 hours, you will have 80% recall. They've proved it in various studies and things, right? Because your brain says, oh my God, it must be important, we've looked at it again. But if you ignore it, and don't worry, these answers are all on Blackboard, so no need to rush through writing them, okay? I've taught this in the past, and when the students have come back the next week, they've said, we understood it completely when we walked out, and we haven't looked at it again, and now we can't remember anything. Or they went to do a question the night before, so it's effectively been a week without looking at it. They said, we just can't remember it anymore. So if you do one question at the back of the book within 24 hours, so by this time tomorrow, do one. Tonight, first thing tomorrow morning, okay? Now, next week is GST, and that's pretty light, so there's probably a bit of time to do one of these questions in class, but Kylie will guide you on that. So thank you very much. Good luck. Now, just remember, with the final exam, because we're doing businesses, right, you don't need to worry about things like self-education, private clothing, travel to and from work, all that sort of stuff. So you can see from the questions at the back of each topic what sort of things we'll be concentrating on. Good luck. And what I tell my students is if you want to post a question on discussion board, please do so. And then I will send me an email, say I've posted, and I'll answer it on discussion board. And then that way we can all benefit from the answer instead of me sending a million emails to everybody, or, you know, to people.
Could I just ask about the result for the
Essay?
Because I saw a mark, but it's disappeared.
Yeah, it shouldn't have been released until all the papers had been marked,
Okay.
and they all haven't been marked. So I've just
Right, okay.
shut down the thing.
Sure.
So you will get it.
Cool.
We aim for 2 weeks,
Okay.
which I think is next Monday.
Okay. Wonderful.
So yeah, you'll get it. Right, good luck.
Thank you. Okay. Statistics.
Yeah, just do the questions.
Hey? Let's skip it out.
No, I want to. I'd love to.
Might. I don't want to tell you what to do either way. I'm not sure what the right answer is. I'm not sure what to tell you because it's. I think this. The board said that this lecture is pretty heavily weighted in the exam, but at the same time, 20% of your markers for the financing. So it's a tricky balance.
You guys have a class in here? You guys have a class in here?
Yeah. Statistics right up. Yeah, on Thursdays after these two, I just go home. I'm done after the 6 hours.
Yeah, she does.
Yeah, but it's at 8 a.m.
Yeah.
All good?
You know that he knows already.
Yeah, no, he's not taking that.
IRR, you have to calculate on the NP, on the discount value or on the original cash flow.
Wow.
On the discounted cash flow or on
I did it last semester. From memory, you don't have to calculate it. You just use Excel to compute it.
Yeah, but the cash flow should be we should use the discounted cash flow or the original cash flow.
I don't remember.
I
It's
think
just saying cash flow.
It's just a cash flow.
it's just the cash flow, right? Then 64% is done.
Yeah, because if you use that to as your discount rate, it gives you
So,
an
but-
NPV of 0.
Oh,
Yeah.
okay. So,
So yeah.
The IRR. The IRR that gives you the discount rate you'd have to apply in order to have an MPV equal to 0.
so I thought
So the higher it is, the better the project.
See,
See you, mate.
hopefully I won't see you after.
Yeah. Okay. If I'm going to stay after this, I'll head to the Abacus Labs. So if you want to see me, I'll be
No,
there.
all I see today what I do is that today is going to do that I take the Excel sheet of both balance sheets, the wrong one and the brief one.
Are you talking about finance still?
The balance sheet of our
What are you doing that for?
no, because you told there's something wrong with that because I
Yeah.
So for safety I'll
The notes, the balance. Just look at the notes. No, double check the notes.
yeah. I just take a copy for at least because we cannot access it tomorrow and it's wrong.
Yeah. I've got a copy of all of our transactions. I printed that out yesterday.
I think it's from the servers.
Yeah.
Yeah, thank you.
See you, man. I'll be back. You gonna stay? I'll be back.
No, it's good. Probably know that. It's not a tell you, bro.
Excuse me. This is your finance. When I finished mine, I said that I had some fun, like going up to year one and changing the price by like 5 cents and watching the whole thing just go like.
So, I've got some incremental earnings after tax, plus change in net working capital.
Thai yield investment. Row 42. Changes in net working capital. Salvage value of equipment after tax.
Tax rate is 35%.
Yeah, that's right.
So,
Appreciation, not depreciation.
anyway, so forget about the
Sorry,
spelling
mate.
for now. So that's add back in the depreciation up to a cough up here.
Yep.
That one, that one, that one.
Is that right?
Yeah, I don't know.
That should be 32.5 million, not 1,000. I think because it's $130 million asset, isn't it?
Yeah, why have I not got about that?
It's a
130.
asset.
It is, yeah.
Yeah.
So it's equals that divided by 4, isn't it? 32,500,000.
Yeah, you've got 32,500. That'll fix everything up.
No.
Yes.
Hello. Looking very sharp today.
Got very headache.
Ah,
Headache.
ah.
You know, changing stuff, marking.
Yeah.
Huh?